The feeling along Bay Street this morning, there is a lot of anxiety, there's a lot of uncertainty, and we know that's something that investors don't like, and that is very reflective on the markets. As you say, it's been a tough couple of days since that announcement on Tuesday from President Trump, a 10% tariff on most global imports. We know the president has acknowledged that's what's happening on the markets, but kind of downplaying it, saying long-term this will be good for American business, for investment, for the markets. Many are wondering, though, is that actually going to be the case? Let's break this down this morning. I want to bring in Ian Lee, an associate professor with Carleton University's Sprott School of Business. Good morning, Ian. Thanks for taking the time to speak to us. How would you describe the markets over the last couple of days and the impact of Trump's tariffs?
They're very jittery. There's no question about that. There's a tremendous nervousness out there. The overarching nervousness is whether these tariffs, this tariff war, this global tariff war, is going to tip the U.S., largest economy in the world, $30 trillion, 28% of world's GDP. Is it going to tip the U.S. into recession and thus pull down other much smaller economies, Canada, for example, Europe, which is about 18 trillion, huge, but still much smaller than the U.S. This is the fear. And so this is why the markets are reacting so negatively. The Dow future for today is down 1,000 points, suggesting that the Dow is going to drop another 1,000 points today. So it's looking pretty ugly.
And you speak of recession. I mean, we've talked to experts who say we are absolutely going to see a recession in the States and very likely here in Canada, but we still don't know, right? What would be some of the key indicators if that is, in fact, what we're going to see here?
One thing we're going to look at is GDP numbers, of course, because GDP is an early warning signal of total revenues, the total growth in the economy. Another, of course, is unemployment. Because when companies are, I'm talking large companies, are early, they really monitor this very closely. And so when they see, and they've got their own internal data from their own sales, from their stores and their outlets all across their chain, their system, and they can see when the sales are going down, and they will start to lay off in anticipation. They won't wait for 3 or 6 months to say, oh my goodness, we're losing money, we got to start reacting. The IT systems and their information systems in these big companies are so sophisticated and working in real time. That is to say, the data is flowing in real time to these companies, so they know what's going on in the marketplace in their own company. So I expect you'll see companies reacting with layoffs. That's another critical warning signal to watch.